All right, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 16th of June. Have quite a bit to go over with you today. Excited to share with you a couple of things that I found, but I want to start off with going over last Thursday. I said the market looks toppy. I guess it was probably last Tuesday, actually. We decided the market looks toppy. Today, has anything changed? Has anything changed since last Tuesday? What do you guys think? Has anything changed? The market's been bullish. Well, kind of, but I think it's been more sideways than bullish. That is an interesting comment. Anyone else have any other questions before I move on? Fear of the Fed. So, Maud, that's a very interesting comment because I don't know. I'll be honest with you, I don't know if it's fear of the Fed or pleasure of the Fed, meaning that the Fed might do a rate hike. I doubt they're going to, but let's take a quick look at our charts from what's happened. Looking at the Dow, since I made that comment, I most likely made the comment. So this is Friday, Monday, Friday, Thursday, Wednesday, and then it was made right there on Tuesday. That red one, it actually passed below the 50-day. But looking at what's happened, pretty flat, except for we've got a crossover. We have a crossover, and we have a crossover. So since last Tuesday, we have 3 technical crossovers on the Dow, which means we are back to a bullish market. Taking a peek at the S&P, it looks exactly the same. Back to a bullish, technically speaking, even though it's sideways moving market. And the NASDAQ, even flatter, just can't get above that 50-day though. But still, technically speaking, we're bullish. So if you were to ask me, has something changed? The correct answer is technically we are now in a bullish market. Now, technically it's a sideways market. And I'm going to tell you it's sideways more than bullish. But you have to go with what is being said. With that said, I'm just going to give you thoughts. Thoughts on our market through summer. Still worried about the FOMC meeting on Wednesday because Powell hasn't caved to Trump at all. I have a really hard time seeing the stock market go bullish on a possible rate hike expectation in July. I don't see the need for a rate cut in July, period. Yet there's like now a 50-50 chance that we're looking at a rate cut in July. I don't understand it. I don't get it. There should probably not be a rate cut in July. G20, end of June. and President Trump and Xi need to meet, otherwise another round of rate hikes. This worries me. I don't see I'm not sure I see a way for Xi to save face unless Trump agrees ahead of time, hey, if you come, I will give you a concession of some kind to save face. I think that's rather rude in that culture. But I do think there has to be some concession agreed ahead of time for Xi to come to the G20 meetings. Summer doldrums usually require longer term short calls on positions to make something through the summer. Yet, I can't find the catalyst to pull the trigger because the risk seems to be to the upside. As you work through all the numbers, the rest of the world isn't doing so good. China is doing particularly bad, but the U.S. looks ridiculously good. So, I think the risk is capping to get through summer doldrums and finding some good news or some progress made with China and seeing things rocket up and get you in a called out type of position. With that said, finally, Morgan Stanley worked my numbers. If you go back 2 or 3 months ago, Morgan Stanley says it sees higher forecasts for Disney's direct-to-consumer streaming service. And they're close. I'm pretty sure I had a 157 to 159, leading to a new price target of 160 and a 210 bull case, up 55%. So, I don't know, pretty interesting to see a big name, a Morgan Stanley, push Disney over the 140 and coming up with some stuff that I pointed out to you guys way the heck back in, probably 3 months ago. Then the next day, Imperial Capital, which I have no idea who these are, downgraded Disney from outperformed to inline. So hence, we took a hit today. If you don't mind me asking, which upgrade or downgrade is more important? Which upgrade or downgrade is more important? Which upgrade or downgrade is more important? It's funny because I see some question marks. There you go. Morgan Stanley. So, Dave, why is Morgan Stanley more important? Why is Morgan Stanley's upgrade on Disney more important? Is it because I'm going to Disneyland tomorrow and Thursday? Lance, you got to keep it clean for me to be able to say some things on what you're going over. Yes, please spend all your money at Disney. Way to go, Mod. Let's just say it can be a pretty penny when you're bringing 27 Hurleys to Disneyland, is all I'm going to say. Happens to be my parents' 50th anniversary this week. So we got all the brothers together with mom and dad. We're in a world mark. Pretty big day for them. In fact, on June 21st is their 50th wedding anniversary, and that's also the birth of my first daughter, Jordan. So we're going to live it up here a little bit. But what is more important? And we just got another comment. Morgan Stanley might be more cautious, so they put careful thought into it. Good comment. Well, the short answer is Morgan Stanley is obviously more important because they're a better known name than Imperial Capital, and because they have trillions of dollars invested in the market, whereas Imperial Capital I don't even think has $1 billion. So the weight of the it's like a teenager trying to play professional baseball. They might be someone on a high school team, but when you're up against the pros, there's no teenager, no matter how good they are in high school, that comes anywhere close to a pro or being able to compete on a pro level. And really it comes down to because of the trillions of dollars Morgan Stanley has in the market versus, if I remember right, not even $1 billion from this Imperial Capital. So did bring Disney down 88 cents, still held the 140. You could take it on a technical level. We literally saw Disney move from the 135 and change up to the 142. The move down today was only 88 cents. So we saw a $7, $8 move on the Morgan Stanley upgrade and an 88 cents move on the Imperial Capital. And guys, this is the beauty of collar trading. In the last couple months, look at the 6-month chart. The last couple months, all we were able to do is really lower the cost basis a little. But we kept us in the game on Disney to go through a great earnings in April and now a pretty sizable upgrade. That's the beauty of a collar trade. Some of us entered some long call positions on Disney, some leap long call positions on Disney. That is the benefit of a collar trade. That's the benefit of being up 4.45% when the S&P is only up 0.09. Pretty sure 9,000 shares, call vertical, couple calls in there. Boy, the 9,000 shares of Disney doing fabulous. Quite a nice run up. Probably my top winner month to date behind Apple. Apple's up 72, Disney's up 60. Visa, Under Armour, Facebook. Unfortunately, for some of us, we are in Baidu, which is my biggest loser. But Baidu also has the biggest opportunity to come back. If we can take a quick look at Baidu, we might be going out to some leaps on what we have left, because Baidu has an unbelievable opportunity to come back from this trade war. 277, 284 intraday, and that goes back to June of last year. 284 intraday all the way down to 114 right now. We're talking $172 of potential upside on a company that's been whacked by a trade war. $172, 150% upside almost on really until these last earnings. The earnings have been in line, if not better. It's just been a trade war. $172 of potential upside. Pretty significant opportunity. What a pop this sucker could have on any trade rumors that China and the U.S. are going to get things taken care of. This is why I trade. The reason why I trade the way I do, one, I'll admit I'm scared to lose my money, but we collar trade over sometimes extended periods of time until fundamentally sound companies come back. So that means sometimes we overprotect. Sometimes we wait longer than we thought we would, and eventually we then make a killing as as the stock recovers. What's the best part of collar trading? That's a question to you guys. What's the best part of collar trading? Sleeping at night. I like it. What else? Protection. Okay. I think that's the same thing. I like it. Picking up more shares with the long put profits. So I'm going to call that dollar cost averaging without being asked to put more money into your account. Any other ideas? Leave it to Dave. You are correct, Dave. Making a killing when it comes back. And really, guys, all this takes is an extreme amount of patience. But if you have 4 or 5 that are coming back, you can have an amazing year of recovery. One like you've never had before with a 20, 30, 40, 50% return on your portfolio. If you're to ask me where I think we're heading for this week, little conflict here. I'm going to tell you down. I'm really worried about tomorrow. I'm worried about tomorrow because I just don't see Powell caving. I don't see Powell succumbing to the demands of Trump. So because I don't see that, I'm not sure that I'm looking at the market going higher. I hope I'm wrong. But if you were to ask me where I think we're going to end this week, I think it's going to be lower than we're at today. And I think the catalyst is 0 to no comments in the Fed minutes on a rate hike. I do think we'll be up 3% for June. Earnings, we have Adobe tomorrow. We have AOBC, American Outdoor Brands Corp, on Wednesday. Oracle, Winnebago, Kroger, and Red Hat. I'll be honest with you. I'm not sure I'm going to choose any protection for AOBC or Red Hat. Red Hat's being bought out by IBM. They've been being bought out. They should be at $190 a share. They're at 186 and change. No reason to protect Red Hat. AOBC is down so low on profitable earnings. I may just do a catastrophic, very short-term, 1-week protection out of the norm for Outdoor Brands Corp, because they just can't get beat up any worse. Last time we talked about this was around the $9 mark for Ford. So I might be a little outside of the box because of some unique situations. An interesting comment was just made, and we're gonna jump on that really quickly because I'm gonna go ahead. I want to go to Baidu right now. If we take a Baidu quote, Baidu has its earnings coming up on the 30th, estimated, so it's probably gonna be the first week of August. So if I was to take a look at Baidu, and we're kind of topping out. If I was to look at an August covered call on Baidu, Lee, where would you put a covered call on Baidu, trading at 114 right now? I'm going to pick on Lee for a second. Let's go through Baidu, and I'm going to go ahead and say, Baidu's at 114.33. So, Lee, where would you put a covered call out to Baidu? And if you want me to change my dates, go ahead and give me a change of dates. But kind of going through the next earnings, where would you put a covered call on Baidu? What strike price? You should be able to see my screen there. I like a little bit of growth, so I might do the 120, and I might look for 480 or 495 of credit. So let's do a little bit of math. I love this comment that was brought up. About 120. I'd probably go 122, right? 120 as well. So a covered call on Baidu. You buy to open, shares at 114.33. You sell to open a covered call for August 120 for $4, and I'm going to give you 90 cents out of the 480 to 495, right? I'm going to give you 490. Net cost basis, which is also equal to the risk, is equal to, as I get a calculator, 114.33 minus 490 is 109.43. Maximum profit is equal to 120 minus 109.43 is going to be $10.57, which is equal to $10.57 divided by 109.43. Pretty nice profit, right? 9.65% return on risk. But if you take the 490 and divide that by the cost of the stock, 490 divided by 144.33, 114, excuse me, 490 divided by 114.33 equals 4.2% risk covered, and still have 95.8% of your total invested capital at risk. And wouldn't you put it at resistance? Well, a covered call strategy, you're trying to get called out to book your profit, which is usually 1 to 2 strike prices above. You could put it at resistance if you wanted to have it expire worthless. Yes, I mean, the reality is I'm kind of going for a different comment here. And that different comment is 120 could be a pretty good resistance on the drop down, right? But yes, you would like it at resistance, but I'm kind of going for a little different comment here. The comment is a covered call strategy is never truly protection. You still have 95.8% of your total invested capital at risk. 95.8% of your total invested capital is at risk. Where if you added a protective put or caller trade, buy to open 114.33 stock, $115 is going to cost you $7.25. Buy to open in August, 115. Long put for $7.25. New cost basis is equal to 114.33 plus 7.25. 114.33 plus 7.25 is going to equal 121.58. New risk in the trade is equal to 121.58 minus 115, which is equal to $6.58, or 1658 divided by 121.58, or 5.4% of your total invested capital is at risk, meaning you've protected, and this is what Maud was going for earlier, you've protected 94.6% of your total capital in the stock market. And you can lower that now that your protection's covered. In a caller trade, you're not as excited to get called out as a covered call. You're not trying to create that monthly or bi-monthly income, in which case I might only go out to like a 140 for $1.93 to lower my risk. I might even do 145 for only 64 cents, so that I'm not going to get called out and I still have upside opportunity. That's the beauty of caller trading and why we do what we do. Now the question is, do you have the patience for it? As I look through this week, no earnings are moving the market. I might not even protect like I normally do for a couple stocks. Empire kind of came in crappy today. NAHB came in crappy. I didn't look up the net to long-term tick flows yet. Building permits and housing starts tomorrow, probably won't be all that good, but the FOM rate decision will be the market mover for the week. Initial and continuing claims, current account balance, Philly Fed leading indicators, existing home sales, and the monthly options expiration on Friday. Draghi starts a two-day speech, has a potential to move the markets, but nothing came of it today, I don't think. If you look how I'm looking to trade, headline risk and adding protection as needed. Really keeping it on longer than needed for the unexpected. Interesting conversation. Kiev was a little worried, and Kiev made the comment from last week, you know, I probably should have taken some protection off sooner. But who would have thunk, right? Who would have thunk that a couple comments would move our markets as much as they did? Fundamentally, nothing's changed. We're still trying to screw China. They're still trying to screw us. We don't have an agreement. All the risks remain on the table. And it was kind of an interesting conversation with Kiev that, you know what? You made the best choice with the information you had. Make your best educated decision with the information you have in front of you. That's all that you can expect. Yeah, but you know, sometimes it's not right. Yeah, sometimes it's not right. Last year was my worst year trading for individuals as a group as I've ever had. It's also, in all honesty, the first year I've gone through tweet risk and headline risk from a president like this. It's just different. But I'd rather be overprotected than underprotected, especially coming to the end of a 10-year historical bull market run in our stock market. I'd rather be overprotected than underprotected. Interesting, Morgan Stanley economic indicator just suffered a record collapse. I didn't know they had this indicator. I highly suggest you read through it and go through and look at the collapse that this indicator gives you in regards to our economy. In all honesty, probably just a blip. Probably just a blip because the creation of jobs on the non-farm payroll and the private payrolls probably isn't as bad as it looked. They probably just didn't get some stuff added in. Look for a big revision next month. Visa, strong growth and attractive valuation. An example on why it's maybe time to live through some small pullbacks on Visa. And this is from someone that doesn't own Visa, that's in MasterCard, but thinks Visa is a prominent competitor to MasterCard. Definitely a good read. I found an interesting article, 15 mistakes even smart people make in retirement. And most of it I enjoyed, except for the first comment, claiming Social Security too early. Obviously, Cameron did not work his numbers. There's no way you should wait until 70 to take your retirement, when you can take it for 7.5 years before that. If you wait till 70, it's like 90, you gotta live to be 94.6 just on a dollar value to break even, and that's not even counting inflation over that time period. I'm going to tell you, if you work your numbers, taking it at age 62 mathematically will be in your best interest over time. Interesting, continue to work after claiming Social Security. You could lose $1 benefits for every $2 earned. That's rather shocking. Obviously, you shouldn't carry debt in retirement. Being too conservative with investments. I really like number 4. Don't be satisfied with a 3%, even though it is tax-free. A 3% return over time, you should do significantly better than that. Being too aggressive with investments, I understand. That's why we protect. Overexposure to one stock or asset classes, options can minimize that. Not knowing how much to withdraw. Again, you've got to work your numbers, and you probably got to work your numbers every 6 months when you're retired. Failing to take a required minimum distribution. Don't lose half of your required minimum distribution because you don't take it. Dismissing annuities. I do think there is a time and a place for annuities, but they are extremely expensive. Only thing that's maybe as expensive or a little less might be mutual funds, or probably a little bit more and or a little bit less, but very expensive. Not updating your investment strategy. That shows you your first strategy is not working. Overspending in early years of retirement. I can totally see how that could happen. Not considering a home equity as a source of income. Unless you don't want to leave a home to your kids. Neglecting to plan for long-term care is obviously important. Not having estate plan documents. You should all have a trust. Underestimating how long you'll live. I think we do live longer. A really interesting article I suggest you go through, but find out what works for you and what doesn't. Very interesting article as I work through some of the numbers on Europe. I still think our risk is in Europe over China, and working through some of the numbers on their growth and money that's owed, it definitely shows you a risk, and why I was paying attention to Draghi's speeches this week. I like the Goldman Sachs is trying to be more successful in their investing, and they're coming up with they're combining all of their, basically they're combining all their private investing units into one total asset, total managed fund. I could really help these guys, I think. And a little bit on, if President Xi does not attend the G20, what's at risk for China? Some pretty good information that I would suggest you take a peek at and read through. With that said, I'm finishing up a little quickly today. Any questions you guys have? What was the best age to take Social Security? Lee, it's different for everyone, but my recommendation would be if you took it at age 62, it's like till you're, 90.6 years is when you're going to break even if you take it early. And that's not counting inflation. So my suggestion is obviously to take your Social Security as early as you can. 62 is what I mean by that. And it definitely does not seem viable to push it out to age 70 if you want to use it. So if you're looking at Social Security, I'm planning on taking mine at age 62 unless I absolutely don't need it. But heck, it might not even be around 20 years from now, so who knows, right? Who knows? But for those right now, if you are not working and you're plan on living off of your passive income, your investments, if you can take it at 62 without working anymore, that's a good time to take it. Mathematically, you'll break even at like 90.6 years or something. And if you're looking at waiting till like 70, you don't break even till 94.8 or 0.6 years out there. It's really, really kind of ridiculous. So sooner is usually better than later if it's your only source of income. If you're working, you lose your benefits pretty quickly there. Any other questions you guys have? If not, I don't mean to run on you early, but I've got my family all here, and we're doing a week long mom and pop's 50th wedding anniversary. We're excited for them. So I am in front of my computer this week. Last week I was out of pocket as I hiked up the Grand Teton and back around through Jenny's Lake. I am paying attention to the markets. I'm not going to call it a vacation, even though it probably is, Maud. Trying to keep my clients working, making them know that I am working, and obviously following the markets from start to finish every single day. Guys, have a wonderful week. I'll get this posted most likely tomorrow morning as soon as I get the approval for it, and we'll go from there. You guys have a wonderful night. I appreciate having you here, and I look forward to talking to you next week. Keeve is up to bat again for Tuesday, Thursday. For those Keeve fans that are out there that enjoy Keeve, you'll get some trades from him Tuesday and Thursday. And boy, there's some good opportunities right now that you might take advantage of. You guys take care. Have a wonderful evening, and I'll see you next week. Bye-bye.